Okay, so now we're going to break down a concept that is very important in the world of business combinations and consolidations. Okay, and this is something that's definitely going to get tested on your exam. So we need to understand the difference between controlling interest and non-controlling interest. Okay, so let's start by talking about controlling interest. This refers to the ownership interest held by a shareholder, groups of shareholders, or another company. Okay, and this is going to give them the power to control the operations and activities of that company. In most cases, controlling interest is established when an entity owns more than 50% of the voting equity shares of another company. This controlling interest gives the entity the power to dictate the financial and operating policies of that controlled entity. Okay, so ultimately here, this is Shark Corp acquiring over 50% of Minnow Corp, and they now have the ability to dictate the financial and operating policies of Minnow Corp, and that can significantly affect the profitability and net asset value. So let's say that Shark Corp decides to buy 60% of Minnow Corp shares for $6 million, believing that the software potential is huge. The remaining 40% of Minnow Corp shares are distributed among various other investors. So by owning 60% of Minnow Corp shares, Shark Corp now has a controlling interest in the company. So this means that Shark Corp has the power to influence the operations and strategic direction of Minnow Corp, even though they do not own the entire company. So they can dictate the management operational policies and major decision-making activities due to their majority stake. For instance, Shark Corp will typically have the right to appoint the majority of the board of directors at Minnow Corp, which in turn has the power to hire and fire the CEO and other key executives. They can also guide the development and marketing of Minnow Corp's software product to align with Shark Corp's broader business strategy. In terms of accounting, because Shark Corp has a controlling interest in Minnow Corp, it will need to consolidate Minnow Corp's financial statements with its own. So this means that all of Minnow Corp's revenues, their expenses, assets, and liabilities will be included in Shark Corp's financial statements, along with an adjustment for the 40% of Minnow Corp that Shark Corp does not own. So this portion that Shark Corp does not own, right, the other 40%, is what's referred to as non-controlling interest. Okay, so now talking about non-controlling interest, also known as minority interest. So as we mentioned, this is the portion that is not owned by Shark Corp. This is the portion of equity in a subsidiary that is not attributable directly or indirectly to the parent. Okay, so in this case, Shark Corp would be the parent. In a consolidated balance sheet, non-controlling interest is presented in the equity section separately from the parent's equity. Okay, so that's very important to keep in mind when it comes to consolidated financial statements. In other words, it's the share of a subsidiary's net assets that the parent company doesn't own. So even though they don't control the company, non-controlling interests still have a claim on parts of the company's profits and assets. From Shark Corp's perspective, even though they own the majority of Minnow Corp, they don't own it all. So when they consolidate Minnow Corp's financial statements with their own, they'll have to take into account that they don't own 100% of Minnow Corp's net assets. For example, let's say that at the end of the year, Minnow Corp reports net income of $1 million. Shark Corp owns 60% of Minnow Corp. So it would record $600,000 as its share of Minnow Corp's net income. The remaining $400,000 would be attributed to the non-controlling interest. In Shark Corp's consolidated income statement, the full $1 million of Minnow Corp's net income would be reported, but then $400,000 would be subtracted out as the portion of net income attributable to the non-controlling interest. Similarly, on the consolidated balance sheet, Shark Corp would report all of Minnow Corp's assets and liabilities, but then separately show the non-controlling interest in Minnow Corp's net assets, right? When I say net assets, we got to ask ourselves, what is this net of? So this is assets minus liabilities. So that's going to be reported as a separate line item within the equity section. Okay, so if we think about this, the non-controlling interest reflects the fact that a portion of the net assets and income of the consolidated entity belongs to other investors, not to Shark Corp. This is important because it gives us a clearer picture of the extent of Shark Corp's actual ownership of Minnow Corp. Okay, so taking a step back, on the exam, we need to understand conceptually the difference between controlling interest and non-controlling interest. These types of questions are fair game. All right, but as we dive deeper into the weeds, we are also going to need to know how to calculate controlling interest and non-controlling interest, as well as the journal entry for the acquisition within a business combination.